who pay when a currency is debased, who suffers? Basically creditors and savers, those who have done the right thing, who've led disciplined lives, who've been prudent, who've been cautious and conservative over the decades. That mentality of the 1930s, that is trashed. Why? Because as they see, in a limited way, in an extreme way, was seen, say, in Weimar Germany in the early 1920s, that the purchasing power of savings simply disappears. Who wins out of all of this? Debtors. Why? Because their debts are inflated away, which was a mortgage of $200,000. If the purchasing power of the currency disappears, then they cheer hooray if it's inflated away. So politicians who are extremely astute in one particular way say, hang on, the majority of Australians by and large are debtors to a greater or lesser degree. We're constantly trying to sniff out where the votes lie, and ultimately the coalition of debt, the coalition of inflation, the coalition of profligacy is going to triumph over the coalition of prudence, of savings, and of caution.
Chris Leithner is my guest. He's from Leithner and Company. This is ABC Local Radio. My name's Steve Austin. It's 7 minutes to 8. I think your point's been made quite strongly on that issue, Chris, and I might just ask you one other, if I may, about the other side of the planet, and that's or over the Atlantic in Canada. The United States President Barack Obama made a visit to Canada, and it was sort of looked at in the most amusing way by most reports, but he did something very serious there. He went and looked at what the Canadian banking system was doing.
Yes.
Largely because, as I understand it, the banking system in Canada is very strong and very healthy, and they haven't made the mistakes that everyone else has made. Just in brief, what have they done right? And apparently even their superannuation system is looking very strong and healthy. What have they done right that the rest of the world did not do right?
Not so much what Canadians have done correctly or what Canadian bankers have done correctly, but things that they have not done. What have they not done? They have not encouraged residential real estate to rise to levels as it did in the Irish Republic or in England or in the US or indeed in Australia and New Zealand.
So they only lent to people who could pay the money back for home loans?
That's a part of it. And I get the critical point I'm getting at is that with the exception of what's called the lower mainland of British Columbia, basically metropolitan Vancouver, a typical Canadian house will cost something like 2.5 times an average Canadian family's income. Compare that to, in parts of Australia, 7 times. What I'm getting at is because, or the answer to your question has to do with real estate prices which have not gone well out of whack. What that will mean, I suspect, is that there will not be a wave of
mortgage defaults,
mortgage defaults, arrears, and so on, with the one exception potentially of metropolitan Vancouver. Because of that absence, there's not going to be the issue of Canadian banks having suddenly to write off a big amount. Now, there have been some write-offs, and I'm not minimizing that. But the answer to the question is because residential real estate did not rise to fantastical levels as it did elsewhere, banks kept relatively cautious. What's called the reserve ratio is relatively higher there. I'm simplifying drastically. The amount kept in reserve in vaults rather than being lent out to businesses.
So they actually had cash reserves to meet their obligations at a much higher level.
Well, any bank under banking legislation, whether it's in this country or elsewhere, in effect is bankrupt. If everyone who has a checking balance decides they want to convert it into cash tomorrow, no Australian bank is going to, no British bank, no Canadian bank is going to be able to do that. Why? Because reserve ratios are typically on the order of 10% or so. Canadian
10% of their actual loans or debts?
In very rough terms, that's right.
Okay.
Right. In Canada, the reserve ratio is a bit higher, which basically means the amount of loans pyramided on top of that has been less, given the size of Canadian banks, than it has been in this country, in the UK, Ireland, and etc. So the basic point, they haven't had a real estate boom nearly to the same extent as in the UK and Ireland, Australia, New Zealand, and the US. Absence of the boom will be a much less mild, a much milder bust, basically.
Okay. So what can we learn from them? What can Australia learn from Canada?
That's a tough one, because one of the reasons, take a place...
Or is it too late to learn it?
Well, that's a tough... a place dear to my heart called Winnipeg in Manitoba gets to minus 40 degrees Celsius. Dare I say, that's in the winter, that's one reason why real estate prices there have not risen to the same extent they have on the Sunshine Coast. It attracts people who are very tough, who are dour of disposition Scots of background are not the sort of folks who want to put up their feet on the beach. The competition for beachside places is such that it's innately going to push up prices. But getting back to your question in a serious point, increasing reserve ratios will have something to do it. That's not the same thing as regulating banks. It's encouraging bankers to return to practices which they voluntarily followed in the 1940s, 50s, and 60s. So to give one example, in Canada, the typical mortgage in Canada, basically the deposit was on the order of 40 to 50% of the total purchase price of the house, and the term of the mortgage.
The typical mortgage paid half the price.
That's right. In other words, the deposit was on the order of 40 to 50%, and the expectation was one would repay that remaining half within about 5 to 7 years. Auto loans were much less prevalent, and the payback, again, high deposit as a percentage of loan, a quick payback period. So it's difficult then, or more difficult for prices to get way out of whack under those sorts of circumstances. On the other hand, given a lower reserve ratio, given a culture that's basically, I want X, I can easily get a loan for it. Once you've got the loan, once you've got the fistful of dollars in your pocket, well, the price paid is really of little consequence. Why? Because if it gets $20,000 out of reach, you knock on your friendly banker's door, and miraculously another $20,000 will appear on the loan statement to enable you to borrow even more, until things go into reverse and the bank knocks or the banker knocks on your door and say, oh, by the way, that renegotiation that you wanted to start, the answer is no, and by the way, we're calling in your loans. And we don't much care if you have extraordinary difficulty paying things back. But the answer to your question, I think, has to do with remembering our own history. That loans were I'll go as far to say, in the 1970s in this country, there are people who are listening right now who literally had, well, I shouldn't say literally because they didn't, but figuratively had to crawl over barbed wire to get a mortgage. Mortgages were rationed, there were queues and so on. One had to demonstrate, one had to document until the cows came home that one was able
to repay.
Yeah. Whereas these days, or up until, say, 18 months or so ago, allegedly more attractive offers were pushed into letterboxes and so on, and the incentives were the polar opposite. People were encouraged to borrow as much as possible, which is the polar opposite of what existed a generation ago. Ultimately, if you like, the shovel-ready stimulus, as our dear friend Obama might call it, what's the best shovel-ready stimulus? Prices which are falling, which put the fear of God into people, which make them realize, goodness me, if I borrow today and the price of what I'm borrowing to buy falls, I'm going to run into real difficulty. I need to think twice, I need to think 3 times before I actually take out the loan.
So the picture I'm getting from you about at least the UK and the US at least, is they're doing the very worst things possible to solve their problems.
That's my fear. And I suspect people in financial markets are beginning to recognise that. Timothy Leithner, the new Treasury Secretary, on the day of the announcement of his appointment, the market shot up. After his first press conference, the market collapsed, or I shouldn't say collapsed, but fell quite heavily.
I'm going to have to leave it there, Chris.
Yep.
Thank you very much for coming in once again.
Great pleasure.